So today's Cardinal Lesson, we're going to talk about state and federal regulation of long-term care insurance. It sounds real exciting, but this stuff needed to be regulated. Is back in the 80s and the 90s, and specifically the 80s, I sold a lot of this stuff. I worked for one insurance company, and um, the policies, of course, had to be approved by the state, the individual state. They were all different in every state, but as long as they were approved by the state, the insurance companies could really write all the language in the policies. And, so why are you talking about stuff that happened in the 80s and the 90s? Well, and beyond. Well, right now, if you go on the internet and you do some internet searches, like a lot of people do, and they're researching, long-term care insurance has a really bad name. And people have come to the conclusion that it had huge rate increases. And it's also, people have had difficulty getting their claims paid. And it's all documented. And, as a 50-year industry veteran, it's accurate. I mean, it's not everything you read on the conclusions that the people are drawing on the internet or whatever they're writing in or commenting about. Their conclusions aren't necessarily accurate, but just the fact that people have had huge rate increases and the stuff's expensive and it's difficulty to collect is really kind of old information, because the modern policies are expensive, and I have to define that, but they're priced more accurately and they're not going to have these ridiculous rate increases, most likely. And there's legislation now to prevent them from having drastic rate increases. And then furthermore, there's new types of policies that have been developed that are going to deal with these problems. So I'd like you to get a clean slate and just hear me out. We're talking about this, and I'm going to give you what the federal and the states have done about this with long-term care insurance, some stuff that happened 30 years ago that's still in effect today, and it's been constantly modified. The modern policies are worth looking at. So I want to pass it to Tom. Why are we doing this video today, Tom?
Yeah, I mean, we're doing this video because of all the things that we talk about, all the things that we touch and plan for. Long term care is the most impactful on the family. Like, if your loved one, if it's you or your spouse who needs care, it touches everything. It changes everyone's life that are around you. And so we're passionate about this, right? You need to plan for this. And there's just a lot of sort of caution around thinking about wanting to do long-term care. Maybe they've heard a horror story or they had an experience that wasn't great with these insurance company. And I don't want to, go against what your experience was. If that was your experience, I'm sorry that that existed. I think Hans mentioned that's true. There's been a lot of problems in the industry, but we really just want to walk you through how the legislations work, what is currently in the law, how the modern policies are written, to try to walk you through how that works, and hopefully at least get you to consider thinking about this. Because if you need the care, this would be the most important thing you ever did, buying a policy, if you ended up needing care. So let me bring up the show notes. You can find these at the below the link on our video. They're also on our website at cardinalguide.com. We have the board like we always do. Print it out, take notes on it, read it if you want. These show notes are not going to be real exciting. We have the IRC, the Internal Revenue Code, talking about the long-term care. We'll walk you through what this says on the board here. We have sort of some other things in here. So take a look at it if you want. You're going to read through and like, what in the world am I reading? Watch the video first, and then you can reference the documents there. So let me turn back to Hans, and he'll give us a little bit of a history lesson of how we've ended up where we are now.
Okay. I want to tell a little story about the 1980s. 40 years ago, I was running a pretty large agency, had probably 100 salespeople working for me, and across several states. And we were selling long-term care insurance in a big way. And I was meeting with the company people who were trying to get me to sell more long-term care insurance because they were having such success out in the Midwest. And in the Midwest, they had lined up with the healthcare or the nursing homes. The state healthcare association were helping them sell the policy. And so they were having seminars, and you had to join the healthcare association. But they were selling these long-term care policies like gangbusters, and people were signing up. And I remember one of the executives sitting down with me, where actually we were playing golf, and he was telling me how great this long-term care insurance is for the company. And they said, of these thousands of policies we've sold, we'd only been doing it for a couple of years. We've only had one claim. And I started to think about that. One claim. I mean, what are you talking about? So we collect, you know, millions of dollars of premium. We only had one claim. So that's obviously a very low loss ratio. You can see why this was attractive to the company. But it also, he went on to explain to me, but the claims are coming. I mean, so short term, it was good for the company, but these people are all going to age. And as time goes on, we're going to be paying out way more in claims than we are in, than we're collecting in premiums. So we got to get ready for that day. And so he explained it a little bit more, but this was kind of the wild, wild west in the 80s, where insurance companies would design policies, their actuaries would, their lawyers would. They'd send them to the insurance department. The insurance department would approve them, disapprove them, say you need to change this, and then they'd have something out. It'd be different in every state. And so they just speckle around, and you'd have, it was confusing. I mean, it was a recipe for disaster, and disaster came where around 2000, all these long-term care policies, not just from this company, but from across the industry, literally doubled the premiums over 3 or 4 years. And I'm sure that some of you experienced this with your parents, maybe yourself, if you're up there in years. And then you've certainly heard about it maybe from other people. And long-term care insurance has just gotten a bad name. And some of it well-deserved. I mean, it's people had their premiums increased, they had to drop them. And then specifically when they tried to collect on them, they say, oh no, you weren't in there long enough, or you didn't go to the hospital first, or you didn't provide us this document and proof of this. It was hard to collect out of these things. So what happened in 1997 is a couple of things. Is the IRS had not ruled on these long-term care policies. So we weren't even sure if the benefits, when the people start collecting them, were going to be tax-free. I mean, it goes without saying that if you pay this premium, and all of a sudden now you're collecting $6,000 a month for several years from a nurse, you shouldn't have to pay tax on that $6,000 a month. But it was never ruled on by the IRS. So this code 7702B created what is called the tax qualified long-term care policy. And what it said is, in the language of the policy, to be tax qualified, it needs to require one of two things in order for the policy to pay. And that is, either you need substantial assistance with 2 of the 6 activities of daily living, which, by the way, are eating, toileting, transferring, bathing, dressing, and continence, or you need to have severe cognitive impairment. So either one, that's the bottom line. That's the drug. And this needs to be written into the policy. So you look through the modern policies, when it comes to the benefit triggers, they're identical. I mean, you just sit down. I do this. I read, and I'm reading old policies for people all the time, trying to help them collect on the thing. Or I'm reading the modern policies because we sell them, and I go in there, but I don't have to read about a lot of the substance in the policy because it's written exactly according to the tax law. And so in the show notes, which we're not going to go to because it gives even more detail, you can read in the show notes behind the show, actually 7702B, and you will find that mirrored in the policy language. So why does this matter? This is the IRS stipulating what is a tax qualified long-term care insurance policy. And then they grandfathered in all the old policies. And then they're also saying that there's going to be tax-free benefits. The benefits coming out of this policy, you're not going to have to pay taxes on. And that's significant, but it doesn't really mean anything until the individual states pass or, approve, and then the companies come out with policies that meet this. And that's exactly what happened. Is the National Association of Insurance Commissioners in the same year came out with model legislation that they put to the individual states, and they say, this is what we want you to pass. So we have some uniformity across the United States. And a lot of the provisions of that mirrored 7702B. And so um, you have policies that are now tax qualified that have this very simple and straightforward benefit trigger or qualification for a claim. And they also very clearly meet everything so that you won't have to worry about paying taxes on the benefits coming out of the thing. Okay. Still not that great big of a deal, but I want to go back in history. And Tom learned something just in the preparation for this show, um, that of how we got to where we are. Now, another significant thing that happened in 2006, the Pension Protection Act, we're back to the federal government passing legislation that directly created the hybrid life long-term care and annuity policies. And again, why does that matter? Well, the life and annuity policies, I mean, let's put it this way, is that the people who are now buying these more expensive modern long-term care insurance policy, a lot of consumers, they start paying you $10,000 a year or paying the insurance company. They want some equity. I mean, they want something in there that says I could walk away from this, or what if I die and I'm going to die, but I die without using it. I just fall over with a heart attack and never go to a nursing home or an assisted living or home health care, and all that money's gone down the drain. Well, it's like any other kind of insurance, but people, when they start talking about large sums of money, they want some equity. And a life or annuity policy with a cash value and a death benefit, um, that was created from a tax perspective by the Pension Protection Act. And it was done through a rider. And that's how we got to the modern policies, which are frankly most of what we sell, is that the kind of people of the money that can afford this insurance and that want to buy it are people that can afford the premiums or afford to make the investment into a hybrid life long-term care policy. So I want to push it to Tom, and I want Tom to just kind of share his reaction to all of this, and maybe he can add some clarity of why we're talking about this today.
Yeah, I mean, I think it's important to understand sort of this 7702B provision in the tax code because it is extremely important. Most, if not all, long term care policies written today fall under this tax qualified structure. And so you don't have the situation like they had back in the 80s where you had all these sort of random one off provisions that these companies would slip into the policies. Like, for example, you had to be in the hospital so many days before filing a claim. I mean, there was none of that now. Now, in the past, there was that made it harder to file a claim, led to a lot of this sort of frustration of people trying to use the policy and they couldn't. And so I think that's addressed a lot of that. Not to say these companies are perfect now, there's still issues there. We recommend when we help a lot of people who actually are trying to file a claim, even on a policy we didn't sell, just because we know sort of where to look, where are the common mistakes made, how to sort of write the claim in a way that has the highest likelihood to get approved. So again, we know how these companies work, and so we work with our clients to make sure that gets done. But from a writing of the policy standpoint, they've removed a lot of those provisions, and that is directly related to this 7702B tax code that made it essentially standard across the board how you need to file the claim, and they've removed that issue there. So I think that's a really good one, and a big piece of it too. And Hans mentioned this, but a lot of people miss this, is the tax-free nature of the benefits. If you file a claim, if you need long-term care and you start receiving money from that policy, that is tax-free money coming in to help cover that expense. Why I bring that up is a lot of people, especially people who have money, which might be you watching this channel, say, "Oh, I'll just pay for it." They'll say, "I'll self-insure." Someone, or maybe they've had someone in the past tell them, "Oh, you have enough. You can just self-insure that risk." Whether that's true or not, that we can have that debate later on. But at the end of the day, they miss a very important piece of that, right? If they're having to pay that bill themselves, one, they're using dollar for dollar. They're having to take a dollar out of their pocket, send a dollar to the provider, the care provider, and that's reducing their net worth. Plus, they have to take out more to cover the taxes owed on that money to pull out to pay the care. So again, it's not necessarily as simple as just paying for it for yourself. You got to account for the taxes. You got to see what impact that has on IRMA, that increased cost for Medicare. You just have to see what that does in terms of taxation on Social Security. I mean, it has a lot of different impacts there. Whereas the long-term care policy, that comes in tax-free. It doesn't affect any of that other stuff, potentially allowing your spouse or your loved ones to keep more of that money for what they want to do with it. So again, I think it's just a better way to plan for the need of care is to use insurance, because you get the leverage from the insurance company. You're able to offset some of that risk. That's what insurance is. Let them take on some of that. So again, we can get into more details on other shows of what that looks like. But a key provision in part of this bill was that tax-free benefit out of the policies is now written into the IRS tax code. So you know exactly how it's going to work. And then what the NIAC, the National Association for Insurance Commissioners, essentially all the states got together, agreed that we're going to have all the policies mirror that language. So now it's all pretty standard across the board. So again, important to understand the history, how we got here. It's removed a lot of the sort of the worst parts of long-term care that existed back from older policies. So new policies now don't have any of those issues.
Okay, so we're in the business of selling long-term care insurance to people. So we're going over all this legislation and things that have happened in the past and what we have now. But I personally have long-term care insurance, and the reason, well, my wife and myself, and the reason I have it is if this happens to one of us, it's going to be devastating to our family, and it's going to add to the devastation if my kids are having to mess with taxes and money and cash flows and hiring home health care services, and it's all taken care of. So Tom and I are both CFPs. We believe very strongly in the fact that long-term care insurance needs to be placed appropriately in the financial plan. I mean, certainly we need to make sure you, the consumer, can afford this, or we need to design a policy around what you can afford. And we need to place that. It's better if we do all your financial planning together, and this is just a piece of it, is if we have a strong need for $100,000 a year 15 years into the future, and that need for $100,000 a year is going to go on for 3, 4, or 5 years. That's something that financial planners, something you would want to plan for. So I'm not really trying to sell you a long-term care insurance policy today. I'm suggesting that you open your mind if you're kind of affected by all these things you've learned about long-term care as a distance, inviting you to a conversation and have a conversation with us, and we'll talk about how you feel about long-term care, what you've heard. We'll kind of walk you through how that perhaps is different in the modern policies that we could offer you, and then we'll, within the context of your money, your retirement plan, we'll properly position long-term care. Actually, I checked the wrong box. Is long-term care. A lot of times we pay for long-term care with IRA money. We'll take a chunk of IRA money and distribute it to yourself over 10 years, and it'll be distributed directly into the long-term care policy that covers both of you if you're married. So, Medicare doesn't cover long-term care, and that's why the government is so busy trying to create these policies. Doesn't really have an effect on Social Security. This is a huge drain on income, meaning that if this event happens to you into the future, we need to plan for it. That's we're financial planners, and we're creating income plans for people through the insurance. We're making sure the income is there. Estate planning, a big long-term care event, even for very wealthy people, creates it breaks up a lot of estate plans. Money's put in trusts, money's there to pass on to the next generation, and then things have to be liquidated to pay the long-term care bill. Even furthermore, a lot of times that the person who's in long-term care is not able to make the financial decisions to continue on all the estate planning we've done. So again, and then taxes, that's all we've been talking about. That's the only role really that federal government has in long-term care insurance, is to rule on the taxes. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.